Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Wednesday edition of Benzinga's PreMarket Prep. Spencer Israel, Joel Elconin, Dennis Dick. On today's show, we're talking about Alibaba liquidating. That provided an interesting risk arb opportunity for Dennis, so we'll talk about that. Talk about the earnings we've had from Gamestop, Dave & Buster's, and Signet. The notable overnight movers we had auto sales as well. We have the CFO of Qualcomm departing for Intel, and we have the semis are hot this morning off some news from AMD. So we'll talk about all that and more. We'll take your questions from our chat as well, both on YouTube and on premarket.benzinga.com. Our guest today, Joe Saluzzi, market structure expert, co-founder of Themis Trading. He will join us at 8:35. In the meantime, Joel, what is the word here on the overnight session?
If you're not long, you're wrong. S&P futures trading at the high of the pre-market session, 2884.75. Had a weak 15 minutes after the 4 o'clock close, but man, it was just another buy the dip opportunity. Basis that 6 p.m. opened, you opened at 2866, 65 and a quarter low, and then we just been plowing higher. Target on the upside, that October 10th high, 2,900.75, doesn't seem that far away. Crude continuing to rally, stalling a little bit, tried to get into the 63 handle, turned back at 62.99, still trading up 3 cents on the session. Gold in the green by $1.70, 1297.10, and silver up by 2.9 cents at 15.09. And the Bitcoin futures did hit over 5,000 last night, but 5,090, trading up $165 at 49.80. Triple D, busy after hours session. Where do you want to start? You want to start with this Alibaba?
A lot of individual stock news. And sure, do you want to start with the Alibaba, stuff?
Yep. Tell us about it. How you traded it, how you didn't trade it.
Well,
and,
let's let Spencer break down the news first, and I'll jump into the trading.
The news is that Alibaba's board approved the plan to liquidate the fund. So the fund, which holds 82% Alibaba and about 18% cash, is going to liquidate entirely, and that's the news.
Okay, so it looks like AABA, and we know I like to do that ARB, so I trade them against each other. On that news, lucky I didn't get the beats because I often do fade it when I see AABA go up and BABA go down. I often short the AABA and buy the BABA. But I saw the headline, I was like, "Ooh, that's not going to work here." And then I go and click the details, and the details quite interesting. So they're looking to obviously liquidate, just like you said, but they estimate Alibaba, if they can sell their Alibaba, which they're going to do, they said, through either a private transaction or through open market transactions, that they can sell it up of 177. They estimate that they will give a distribution somewhere between 76.62 and 79.22, which is significantly higher than AABA is trading right now. But last night, this thing traded up to the 76 handle. So when I initially read this, I was like, oh, this is going to trade up on this, and this spread's going to go the other way. I actually bought some Alibaba at 74.5, and I was able to sell. It would trade up in the 75.5 area for a long time. So I had a pretty good trade on it. It came back down. I bought it again. The second time it did not work. Sellers just started to emerge, and I was like, what am I missing? And I'm trying to analyze it. And really, when you analyze it, the only thing I can really think of is really if there's a tax consequences, obviously, for those who are selling the AABA, and then there's or holding the AABA into a major distribution. And then the second thing would be the time value of money. So I'm like, okay, well, maybe, but really, if Alibaba is going to trade above 177, this Alibaba is worth somewhere between 76.62 and 79.22. So pretty significant discount that the Arabs are putting on it at 73.40. But tax consequences and the time value of money maybe is the culprit as to why it's trading actually in the red here now on what would probably be perceived. I don't know if it's definitely not good news for Alibaba because AABA is going to release or be trying to sell all those shares. So it makes sense that BABA is down. it just doesn't make sense as much to me that AABA is trading down too when they're saying they're going to be worth 76.62 to 79.22. I would think a couple bucks down from their tops, which would put it in the 74.75 area. Not the case, though, trading at 73.5. So I would expect AABA to actually drift up here over the course of the next few weeks as this information digests. But the one thing, again, to consider is tax consequences on a major distribution. Maybe that's what the risk arbs are discounting here.
All right. I wondered why Baba was trading in the red this morning with some good economic data overnight from China and Europe. What are you going to let it settle for a couple days here?
Yeah, I think so. I don't have it on now. I had it on last night, the spread, shorting Baba, buying AABA. Took it off, made some money with it. I was up a lot more, so I obviously held out for too long. I like I said, I made money on my first trade, but I went back in it when it dipped. And the dip was not the buying opportunity. So then I ended up, once this trade's not working for me in that case, and risk arbs are coming in pretty heavy, I'm like, okay, I've missed something. So that's all I could think is the distribution is they're worried with the tax consequences and the time value of money, unless I'm missing something else. And if anybody who trades this, let me know if I am missing something else. But from what the release says here, it looks like if they can sell their Baba above 177, you're going to get a payment of 76.62 to 79.22, depending on how much they give for their Alibaba. So it sounds like it's a good deal at 73.5 this morning. But again, the tax consequences behind that could be making it a little bit confusing.
All right. And why are they doing it now? I mean, is it something about the Alibaba stock? I mean, what do you think they're
I don't really get why it would even exist. I mean, what do we need?
Right.
A fund that owns 85% Alibaba or 82% Alibaba and 18% cash. Why do we really need that? And I mean, this is why Alibaba, I was saying yesterday, I didn't realize they had the 18% cash. I've traded it for the last 2 years, basically. I didn't realize they had the 18% cash, which is why I always just said it just lags at a bit. So if Baba's up 3%, it's up 2.5. Well, now I know why. Thanks, Spencer. It's got 18% cash. So I've always just known that's how it's traded. I didn't realize it was because of the cash. So you enlightened me here at the end of my risk arb experience here, because I'm obviously not going to be trading this. And this isn't a risk arb is typically done on deals. I'm calling it risk arb.
That's why I'm here. That's why I'm here, Dennis. That's why I'm here. I live to serve.
You live to serve. So now I know why. It always, whenever I think Bob was up 3%, AAB will be up about 2.5. Today, that doesn't apply, guys, because we've got, this is going to reprice here to a certain extent, obviously on all the factors I just talked about. So if you're trading BABA versus AABA, don't necessarily assume because BABA's getting slaughtered that AABA is going to get slaughtered here today. There's still a relationship there. They still own a pile of Alibaba, but because they're having the intentions to liquidate it, that discount that has always been in there might close a little bit. At least over the next little while, I would expect that discount to somewhat close.
All right. Mary Miller says Dennis is a good trader because he only inhales once for every 3 exhalations.
Panting here as I talk.
Okay.
You should see me on coffee.
Oh, no, I don't. All right. Not much earnings. We're really, it's very quiet here in earnings season here. But, boy, GameStop on the road to who knows how low. But, Spencer.
Officially single digits anyways.
Yeah. Yep. Spencer, give us the report.
Yeah, another in a continuing series for GameStop of disappointing reports. Their Q4 sales was $3.06 billion. The estimate was at $3.28 billion, and their guidance was quite weak. They see fiscal year 19 sales down 5 to 10%. Comps for the fiscal year also down 5 to 10%. The Q1 EPS guidance they gave flat to 0 cents to 5 cents. And that's all week. You don't want to see sales dropping on a year-over-year basis, which is what they are guiding today.
Yeah, I mean,
yesterday.
And this is a stock that we've talked bearish about for a long time on this show. And if you've been listening to a while, it's one we've got right. We get some right, we get some wrong. This is one we've had right. I hated the rally. I hated, everything about this thing for the last while. I just think if it's going to free to play and you're selling video games, that's a tough business to overcome here. So is it going to have little bear market rallies? Sure. But I think the long-term road just continues lower for GME. I'm probably not selling when it's down 11%. You've had a lot of better opportunities to sell this, specifically back when I had the ridiculous rally at the beginning of January. That was the best opportunity to sell it. But I mean, the drift is not good. It's single digits here now. Rating is on the wall here for this company. So I don't have anything good to say about it, so I won't say anymore.
Okay. Pre-market low comes in at 870, and you do have some short covering here a little bit, not too far off that level. I was just going back on the monthlies. That's all you can do on this stock. In September of 2004, you had an 838 low. So boom, keep an eye on that if it goes through the pre-market low. Shorten it, you could shorten it in a hole here. You could, could take a little bit of heat in order to get to the old resistance. Now 10 is going to be a huge resistance. You had all those lows at that area as well as a gap. Were any bids to hit on that, or was it just straight down?
No, it actually went straight down, and then for some reason had a wicked rally all the way back up. So it went down like 820, 830. Then it rallied, or I'm sorry, 920, 930, right in that area. Then it rallied all the way back up to flat, like scratch at $10. Then they actually came out and said, we're not giving guidance anymore. And when they said that, and when that was announced, that headline went by, they're not giving guidance anymore, they knocked it right back down. I mean, there's a reason sometimes companies stop doing guidance, because it never seems to be good with GameStop. So more lack of transparency here going forward for GameStop, not going to give guidance anymore. And that's when it really started getting hit.
All right. Well, we'll keep an eye on that. S&P still just hovering at the highs of the session. How about
typically though, before you move on, the gamers used to always move with GameStop.
Oh, that's right.
That relationship is starting to break down here now because, like we said, EA's came up with free to play. Activision Blizzard, one of their big games, they're doing free to play now too. You just look at it and you can say, oh, why is Activision Blizzard trading up? Why is EA trading up? Why is Take-Two trading up when you've got GameStop down that much? Because they don't need GameStop anymore. That's telling you, because GameStop sales are lower doesn't necessarily mean that they're doing bad over there, the game makers, because they're moving to different models now, and you don't need to have a physical store to sell your games. So that's what it means. It's just not necessarily GameStop's weakness isn't that people aren't playing video games. It's that they can just grab them online. They can, obviously do free to play. The business model has just completely changed, and GameStop has not adapted.
All right.
So don't expect this morning that we're going to see huge weakness in Activision and Take-Two because GameStop is down. We used to see that. That relationship is, I would say, no longer.
And from a bad report to a good report, last I saw, Dave & Buster's was trading significantly higher.
Yep, Play earnings out yesterday as well. The Q4 EPS 75 cents versus a 63-cent estimate. Sales 331 versus $323 million. So beat on both numbers in the Q4. They also added a $200 million buyback. And the guidance that they gave, the fiscal year sales, was, I believe that was in line, about 1.37 to 1.4 billion dollars. They guided that comps were going to be flat to up 1.5% on a year-over-year basis, but an earnings beat and a buyback for Play.
Nice pop for Play here. An interesting chart there yesterday, just intraday, because it got beat here a little bit early, but then they bought it late in the day. So not sure if anybody got the early memo, but had a nice rally late in the day. Now it obviously lifts up 7% here this morning. The only high I would say is 54.07, which is high back on January the 15th. That could be the first level it's going to test, which is obviously testing right now as we speak. I don't know. This is a tough one. I'd say this is a SOH trade for me, which is sit on hands. I just don't see a nice setup here.
Yeah, I see that 54.07 high, but you had two spikes up to 54.47 and 54.46. So that makes me think there's someone wants out of stock right at 54.50. That's just in the short term. So longer it takes to get up and take out that pre-market high, then I think you might get a little fill, but back and fill. But you hold 54, you take out that 54.5. Let me see what I can find. Not much until 55.52. That was your December 7th high. But we'll see what happens at 54 off the open. One thing for sure is it's holding these gains as we speak. So not sure what the short interest is in this one, if shorts are scrambling. But nice move for Dave & Buster's.
Chopping around here a little bit. We just had the ADP numbers come out here, Spencer. You got those numbers for us?
I do not, actually. Let me see.
I do. The March payroll is up 129K.
129,000 jobs in March. So created here. You're seeing S&Ps. They actually went down a couple points. They're kind of just hanging here, though. I mean, this market is just in full run-in mode, and we're going to get to the strongest stocks here this morning, which is going to be your semiconductor stocks here again. They're all ripping here this morning once again. I mean, buying the dip has just continued to work. Even last night, we're trading down 4 or 5 handles relative to fair value for most of the session. Coming this morning, we're up 12. So, I mean, buy the dip is just working on the market, but it's especially working on the semiconductor stocks. AMD, NVIDIA, Intel, Micron, Applied Materials, all dipped last week. All those dips have been bought. All of those stocks are right back at their highs here once again. The strong get stronger, the weak get weaker. Right now, the chips, semis, the PC makers here this morning are very strong. Reasons here for this morning's rally, Spencer. You had a good one.
Well, a couple headlines for AMD. One, they got an initiation at buy from Nomura, and the $33 price target with that. But
Intel
also,
too.
Right, but also Digitimes reported this morning, citing sources at various PC makers, that AMD sales would increase sharply in the second half of the year thanks to a ramp up in CPU and GPU shipments for notebooks, motherboards, and servers. So they are predicting, I guess, a dramatic increase in sales in the second half of the year. So that plus the initiation and a buy, I would imagine that's what's accounting for the what last I checked was a 4% move in AMD.
Huge move in AMD, but not only AMD here this morning, like NVIDIA is trading. Let's just go through them. You know, the big guns here. NVIDIA is trading up $2.50. Micron's ripping this morning. It's up $1.20. Applied Materials trading higher here. We can just go Lam Research is trading higher here. Intel is having a nice lift. Yes, Spencer, we did see the Qualcomm CEO is going to, or the COO, the Qualcomm COO, I believe it is.
CFO.
CFO. Too many middle. CFO is leaving Qualcomm, going to Intel, so that might be helping it this morning too. But Intel, again, it's getting a buy rating from Nomura as well, so it's trading higher here. Once again, Intel's one of the biggest positions in my long-term portfolio, and they're just seeing a big rip in all these stocks this morning. Also, for in the chat there, Buzz T is saying about Dell being one of my favorite stocks, and yes, I did buy Dell on that pullback. Glad I did. I bought in the 57 handle on that recent pullback last week. Glad I did. Stocks trading at 61, so right back. That's just buying the dip on strong stocks, and the dip was there to be bought, and happy that I bought it. Still long.
All right. A lot of these stocks, they're just getting up back to levels like for AMD here. I mean, that really got the kickstart with the Google deal that was announced a while ago. On that day, AMD had a high.
Right, Joel.
Yep.
It pulled back. It gave you a shot. I mean, once you have these breakouts in these stocks and good news, and then the market pulls back a little bit, and those stocks that were strong get hit, when the market turns around, it's going to be those stocks that are leading the way. And I mean, here we are 4 days ago when AMD got down the 24 handle, already in the 28 handle. It's talking about a stock's up 10% in 3 days, 4 days. So now if you're coming in now, you're late to the party. But I mean, that's just what we like looking at. Stocks are in uptrends. I like buying the dip. Stocks are that are in overall downtrends. I like selling the rip, and it seems to continue to work.
And on that day, that Google day, you had a high of 28.11. That's right where you're trading right now. So you are opening into a little bit of daily resistance here. We are taking out as we speak up a buck 36. I do want to just, you mentioned the ADP, right? And I'm just looking at the way the banks are trading this week, and with the unemployment coming out on Friday, it looks like they're looking at a super hot number. Could it be like the Fed and that super dovish talk that they had, with the last meeting? The banks are acting, get a hot number, and higher interest rates are back on the table. Or unless it was just a technical rebound in those things. But don't forget, we do have a jobs number on Friday.
TLT. We said it yesterday on the show. TLT. I mean, here you are. The TLT is down once again. Banks move inversely with the TLT. Had the wicked sell-off there back on April the 1st. Yesterday, tried to rally a bit. We even said on the show yesterday, I'm more of a seller of TLT and a buyer of the banks when the banks were dipping yesterday morning, because there was there was a major move, and then this was a counter move into it. So it gave you a shot. It gave you a shot to short TLT yesterday. Gave you a little shot to buy the banks yesterday because they were dipping a little bit yesterday. They closed strong and they're opening stronger. TLT closed weak and opening weaker. So there you go. TLT down, bank's going to be up. That relationship just holds once again.
Just want to discuss two things in the chat before I forget. The first one was, did you see any ACB? They filed a prospectus for a shelf. I don't know if that ran across your wires or not, but what did you see that news or not? Or is it
no, I've seen it now though. Thanks for ruining my morning. I was doing pretty good on all my semi stocks, and now I look at my ACB and it's trained down to 3%. So I had to poo-poo my happy morning here, Joel. Thank you very much. Yes, offering 750 million in a mixed shelf. That usually means that there's some shares offerings to follow here, obviously. So that's why the stock's trained down here this morning. But I guess they're raising cash when the stock price is high, maybe to continue to fund their expansion. I'm not sure the details. I didn't read the release to see why they're looking at raising more money, but the stocks always trade down, it seems like, when you have that news.
868, and we are trading below that right now. So you have the Nelson Peltz gap to fill here. That would be down to 8.25. So if you do get into that gap area, maybe that'd be a place to re-enter after a nice gap fill. Also, the folks want to talk about WBA a little bit. It got downgraded. Thank you very much. Boy, this thing just went straight down. And then late in the day, someone tried to bring in some stock here. It looks like around 55.5. I'm looking at yesterday's low, 55 even, trying to trade up. I guess I would keep an eye on that $55 level. Did you get to play the CVS off this, Dennis? Because we got down.
I looked at it a couple times. It really kind of did hold those lows. I mean, it got down to 51.93, and yes, it did breach it by 15 cents, but I don't call that a breach, and it held. So that's good news for CVS. It kind of held those lows. I mean, this is a decimal world. When you're talking about holding lows, you can't just say, oh, it breached it by a dime, that's taking it out, now it's going lower. I mean, and it closed above there. It's up here a little bit again this morning. Kramer was actually giving a little bit of love on fast money again last night, which he's been giving some love to CVS. And he was like, he likes this play better than the WBA is what he was basically saying. But it's holding those lows. So that's the one good thing. The bad thing is it's still in a vicious downtrend. The bad thing is they're still going to be fighting Amazon going forward. There's a lot of issues here for CVS long term. Short term, if you're looking for some hope, at least it's kind of still hanging out near that March 8th low.
And for WBA, I just would keep an eye on that $55 even level. I don't know who with the downgrade, but a little bit late to the party. The monthly lows that I talked about yesterday were annihilated. So, but I'll just go back to that again. In February of 2014, you made a 55.27 low. So you're basically getting a 5 years, buy this at levels you could have bought it at 5 years ago. But let's see if you keep a double bottom, there's something at least to lean on. But inextensive downgrade, not doing much to it today. S&Ps have pulled off a little bit. We are leaking 85.75 or at 82 even, but considering we're still up 15 handles. Still a great morning. We'll see. We got balances coming out in 6 minutes. So we'll
let's go to Signet.
Okay. So warning.
It was up this morning on OK Report. It's giving it all back. Bad stocks just become worse stocks. It seems like even on good news here. Give me the numbers, Signet, SIG.
SIG reporting this morning, Q4 adjusted EPS, $3.96 versus a $3.82 estimate. Sales, $2.15 versus $2.14 billion. So the Q4 numbers on the surface are good. The guidance that they gave, however, was mostly light. The range they gave for the fiscal year adjusted EPS of $2.87 to $3.45. The estimate
was for next quarter?
That's for the fiscal year. Fiscal year.
Okay, so they're not made. So they had a huge quarter there. Maybe that was the Christmas season.
Well,
though.
yes, exactly.
So that's why the quarter is bigger. So they're obviously not. So they're saying the full fiscal year is what, $3 and something now?
About $3, we could say. The sales.
You look at that, still trading P at 9 in a declining business. So that's hard to really get behind that.
Sales guidance for the year about $6 billion. Same store sales for the year are going to be down 2.5% to flat.
Declining business, and you're trading with a P of 8 or 9 going forward. You could say it's cheap on a relative basis to other stocks, but I don't like paying P's of 8 and 9 for declining businesses. And that's what the market is saying here too. We got a nice lift initially. Maybe it's a guidance that knocked us down, but we've given it all back and just kicked to the red. We're actually trading flat right now, but we're down here too. How high did we get?
We got way up in the 30 handle here. Let's see, got up
Don't
to...
chase, guys. If you ever listen to this show, one thing we preach is not chasing. And I mean, the people who are chasing a declining business on an okay numbers for last quarter in the Christmas season are immediately punished here this morning. What was that? What was pre-market high?
30.99.
So $31. You're already you're being punished for your chasing because you're already down 10%. You're down over 10% on that purchase if you bought up at $30.99 this morning. Don't chase.
Okay, good words of advice. So did we get?
We don't give much investment advice here, and we don't give any investment advice. But I'll tell you, I've never made a lot of money chasing stocks. I don't chase stocks. Here we are. We've given it back, but holy cow, $30.99. I don't think you have any chance of seeing that there today.
No, and I just looked at the daily chart here, and there's like the bars are. It's just dead. It's just no ranges. I mean, I guess if it really goes into decline mode, I don't know, 23.64 was your January low. That's a low for the year. I guess if you really feel like you need to trade this one today, see if it can stay green. The high was at 27.60, or the close 27.65. In the 20, just use yesterday's range. It was basically a matching range, not an inside day. Inside on the low, lower close, and two highs. We'll call it 28.25. Monday and Tuesday's highs. That's your resistance there in Signet Jewelers, and there's really no sympathy placed with this one out there, right?
People used to reach with Tiffany's, but Tiffany's doing everything right. They're doing everything right. Signet's doing everything wrong. So these two companies don't move together anymore. I mean, you might say, oh, Tiffany's is going to be weaker now, Signet, but when the stock is flat, there's no sympathy plays anyways. I mean, when you're looking at sympathy, you're seeing, stock's up 10%. What's going to move with that? When I see a stock up 1%, I mean, it's going to have not much influence, even if there was pure plays to really go.
What about Movado, MOV?
I mean, again, the stock's just not moving enough to warrant sympathy here. But, you can say that. But when you got a 1% move, I mean, if it was up 10% here today, maybe Movado gets some love. But because it's up 1% or maybe down, we don't even know where the leader's going. So you can't worry about laggards when you don't even know where the leader is.
Look what that Movado did off that report.
What was the report on Movado?
It was a good report. That
3 days gave it all back.
Yeah.
Oh, man.
Yeah. Wow. So let's see. Where did the Movado here? We have just a minute coming to imbalance land. Probably have a lot of imbalances. So we'll just tick away here. And,
let's go to ratings. We got Caterpillar getting downgraded here this morning. Who's downgraded?
Deutsche Bank to hold.
When you go to hold, it's not that big a deal. But anyway, stock is trading down 69 cents here in the pre-market. It's been a nice run, 3-day run for CAT. 131 up to 141 basically yesterday. Pulls back here, 50 cents, dollar. You know what? Hard to really get full-on bearish this thing until it gets under 135. So I'd say I'm going to buy the dipper. Sorry, Deutsche Bank fading on this one.
All right, Dan, nice move here. The dip buying has already occurred. You made a pre-market low of 137.53. You're trading back off that level in the 139 handle. Little retracement here from that 130. What was the high there? To let's call it 140. I'll go with you on that 135 level, but just the way this pre-market chart looks here in the 15 minutes, the buy the dippers already have sprung into action.
Imbalances here, AT&T 143,000 to buy, Dow Chemical 69,000 to buy, significant, just because Dow has been in the news a lot here, obviously lately too, and it's been going straight up since the spinoff here. Jump over here, Pfizer 88,000 to sell.
Much, huh?
Let's go see what Baba. Yeah, Baba 77,000 to sell, but that's because of the Alibaba news there. So we know there's going to be some shares that come online there. So not surprising that Baba is trading weak here this morning. Yeah, there's nothing really huge jumping out at me. I have some trading positions in some of these stocks too.
Okay, all right.
Like I always do.
How many do you have on today?
Not that many. No, I'm light here today, so I'm down. I've got a few this morning. I have 16 positions on overnight. Very, very light night for me. I didn't trade much last night.
All right, I just wanted to just talk a little bit about the move in Facebook yesterday. Deutsche Bank came out with a note they're going to get potential $10 billion in revenue from Instagram advertising, and that stock is on the verge of a breakout here, back at the highs from post earnings. You made a high yesterday at 174.90. With the close at 174.20, you're trading up 20 cents here. So just one other high. It took out the former high of the move. I believe it was 174.03, but 175, you get there and just getting back into that area from the when they had the drop off earnings. So you need to get up into that gap area for Facebook, but a lot of gaps in here. Still ways away from its all-time high.
Back to ratings land, Spence.
Sure. Sorry about that.
Let's go.
Okay, go back to the ratings lane. We mentioned Caterpillar, we mentioned AMD. What about Urban Outfitters getting an upgrade this morning from D.A. Davidson?
Stock is bid up here this morning. Hasn't traded this morning. Was trading last night in the 31 handle though. It's bid right now. Odd lot at 31.26. Bidding 31.07 is the regular bid that you'll see on your level 1 quotes there. Because if you don't subscribe to Arca Book, you're not going to see the odd lot that I see bid at 31.26. So it looks like it's going to trade up 1 to 2% here today on this. Not surprising. It's been on a little bit of a tear here too. I'll say you're going to run into resistance up at 32 though.
Okay, let's take a look at here. An upgrade in the retail sector, up 63 cents. 5-day rally here. More than that.
Been
1,
a nice
2, 3,
rally.
4, 5, 6, 7-day rally here. Let's see if it can continue up. 63 cents at 31.20. Pre-market high comes in at 31.50. So you want to get follow through that area, and then after that. Opens up to the 32.5 is the next daily high that I see. And there was actually 4 highs at the end of January here. So if you're looking for a little bit more of a target, 32.5, 4 highs in the same area.
Elf Beauty getting upgraded from Jefferies, also hold to buy.
Nice lift here for the stock this morning. It's a stock that has been on a pretty good run here too. I don't know if I'm getting behind the whole Elf Beauty run here, though, because you still got a stock that is in a serious downtrend. If you look out to the monthlies, the stock was $30 back in 2017. It's $11 here now. So, yes, it's been a nice comeback from the $7 area, but I feel like eventually you're going to run out of steam. Can the upgrade here help? We're bet at 11, so it definitely is helping. It's probably room up to the 12 to 13 area here, but the rally's getting a little long in the tooth when you've got an overall trend that is still down.
Pesky sellers right at the 1080 level, 1075 to 1080. So could be classified as a breakout now because you are trading above that. Let me see if there's any volume here in this one. No, just there was one big print that might have been across after the close.
You never see big volume in these smaller stocks in the pre-market, though.
No,
so,
not at all.
Not something like this. It's not going to have big volume. It's upgraded. You're going to trade up because it's not widely followed. So when you get an upgrade, it's going to move up 3 to 4%. It's up 5% here right now, so it's getting a nice lift. $11 bid. Nobody's hitting that, so it's telling me it wants to go a little bit higher, at least short term.
Sure.
But I can't see just jumping in here and buying this thing up at $11.50 today or $11.25, whatever you got to pay. I think there is some more upside potential here, but and the recent trend is still your friend. It's just that overall trend is not.
All right, Dennis. Boy, you're going to be torn here. There's a Tesla bull versus bear segment on CNBC, but we could talk.
Mute our show and just listen to this. Who is the bull and the bear?
I'm not sure.
Is Gene on there?
No, Gene's not on. Tasha from ARK Invest, but we want to talk market structure, Dennis. That would be the other alternative.
Joe coming on.
Yeah, Joe Saluzzi. So. All right, let's go get Joe.
All right, we'll be right back in a moment here with Joe Saluzzi from Themis Trading. All right, and then welcome back, everyone. Benzinga's Pre-Market Prep, Spencer Israel, Joel Elconin, Dennis Dick. We are now joined by Joe Saluzzi, partner and co-founder of Themis Trading. Joe, how's it going this morning?
I'm doing well. How you doing, gentlemen?
We're doing well, Joe. Thanks for coming on the show here. I did not want to pull you away from your Bitcoin trading, but we
You're up 20% in a couple of days, huh?
Yeah. We just wanted to get you on the show. We have you on from time to time to talk about market structure, which is important, an important thing to follow here. We got a couple topics. Let's start with the transaction fee pilot and your comments on that.
Yeah, I think, and even before that, I have to say that the SEC chairman, Jay Clayton, and then the new head of the trading division of trading and markets, Brett Redford, these two guys, from what I've seen over the last year or two, year and a half since they've been in office, amazing what they're trying to do when it comes to transparency and changing market structure, which, as you know, I've been an observer of market structure for many years. And usually at the SEC, things tend to just grind away and nothing ever happens. And then the industry gets involved and, you get a distorted look at something that you really wanted to get done. These guys are doing a great job. And I can't give them any, more kudos than what we've been saying lately. Speaking specifically of that transaction fee pilot, that's something that we've talked about even on this show for many years, about getting rid of rebates. And we think one of the biggest problems in the stock market, whether it's retail or institutional, and we put this in our book in 2012, so this is not a new topic, right? 7 years later, is the amount of payment for order flow that's in the system. So on the retail side, it's when, Robinhood sends an order to whichever broker they're sending it to, and they're getting paid for it, right? And they're charging zero commission. And is that a distorted process? And we've talked about that. But on the institutional side, the problem is a lot of institutional brokers will be sending orders to destinations which pay them the highest rebate. So, we're under a maker-taker model on the institutional side, which means when I add liquidity, I get a rebate. When I take liquidity, I pay a fee. And those rebates and fees are different based on the tier that you're in. And that's a big term that we've been using in the industry. The tier means you get more. The more volume you do, the more you get. So there are times that guys are getting more rebates than they are access fees, which basically means they're getting paid by the exchange to trade there. So anyway, it's a distortive thing. And the SEC knew this, and they want to test it. So they came up with something called the transaction fee pilot, which is going to have two test buckets, 730 stocks each. And, the stocks will be determined by the SEC. One group will prohibit rebates, no rebates allowed, and the other group will have a fee cap of 10 mils or a tenth of a penny, where today the fee cap is 0.3 of a penny. So it's significantly be reduced, which also means the rebate will come down. So the theory is, let's see what happens to liquidity now. have rebates been distorting liquidity all along? Have order routing been distorted because of where they're going to which destination? Has best execution been suffering because of this? It's all good stuff, and we applaud the SEC. But who doesn't like it are the exchanges, right? They went nuts when they heard about this. The major exchanges, being SIBO, NASDAQ, and NYSE, and guess what they've done? They've sued the SEC. They filed suit to stop this thing, which is ludicrous in our opinion, to sue your regulator, because they know that their business model is under attack here. So bottom line is, it is set. It has a slight delay. The SEC had to, the other day, actually came out and said that we're going to delay the start of it, but we're going to start collecting data, which is essentially starting it anyway. So we're still very excited about it, and we think it's going to show a lot.
I mean, I'm torn on it, and the reason, and I'd like to see, some changes, obviously, in the market structure. We've advocated for a lot of changes over at Bright Trading as well. The one thing that just it tears me a little bit about the way it is because it didn't include, and maybe like we said on the show a while ago when you were on, is you can't get everything at once, but they didn't include anything on the retail brokers selling orders, obviously, to off exchange market makers and that payment for order flow prospects. So it's like they're attacking the exchanges with their payment for order flow, but we didn't do anything about the payment for order flow with retail brokers, and it's distortive, I would say, even more so. Sometimes because the opportunity cost to those orders that are sitting on the book. So basically, when you have a limit order sitting on the book, it doesn't get executed because you've got an off-exchange market maker stepping in front of it. So to incentivize that liquidity, exchanges offer rebates. So I kind of understand where the exchanges are coming from. So now we can't offer rebates, but you're still going to allow an off-exchange market maker to step in front of our limit orders. I mean, let's, if you're going to, do one, why not do the other at the same time?
Fair point, Dennis. But as like we said before, you can't do them all at once. And
yeah.
This is a heavy lift right now, and they're already getting sued just from the SEC is getting sued just from a piece of this, just a small pilot that they're trying to put through. So could you imagine how they try to do the whole thing? It would have been, it would have just been too much. So
well, the exchanges wouldn't have minded it, I think, though. I think the exchanges wouldn't have been so, so that's the point, that I'm just trying to make is they're kind of attacking the exchanges, but they're not they're not doing anything with the off-exchange market makers that are acting like exchanges.
Yeah, I think they're next. I do, and I think
I hope so.
This takes a long time, right? We've been doing this for years now, and we finally got to why I was so excited at the beginning when I was talking to you. We finally got something done, and for years we got nothing done because the industry goes and they lobby DC. Who do you think hangs around and talks to the Congress people and said, no, this is bad, this is good? Who do you think's funding these research reports in Washington DC? It's the industry. And they don't want things to change the business model that's been built, that's been feeding them profits for many, many years. And it's distorting order routing, whether it's on the retail side or the institutional side. So I think I agree with you 100%. It needs to be done on the retail level. Hopefully this one gets done and we start to see the data, and then we go to the next step.
Okay, and I would be fine with that as well. But it'll be interesting to see, if the liquidity providers do come in, because I don't think they do, for the simple reason is that I don't think we're attacking where the root of the problem is that it's difficult to get execute on your limit order. And the one thing it does is it handcuffs kind of traders like us that, and we do, like I will throw an order on an inverted exchange to try to get a faster execution. And I know if there's a huge long queue on ARCA and NSDQ, if I throw her on NQBX, which is Boston, I'm going to get faster execution. So, and the downside is that, at a retail level, and when you're looking at this, is that you're right. We had the report from Notre Dame professor Robert Patelio there that came out and said that brokers are indeed routing to where they get paid the most. And if you got your broker and they're sitting out there, me knowing market structure, I know I can get a faster execution on Boston. If I really need to get a quick one, I'm going to jump ahead of the queue basically on ARCA. So we are using that as traders to a certain extent to our advantage. But it's also because our limit orders are so disadvantaged out there.
Right, and maybe this actually helps you because now, let's say, for instance, test group one, where there's no rebates, no one's going to have an advantage of you. It's obviously there's always going to be a speed advantage, but you are now on the same tier as everybody else. You're playing on the same level playing field where you might see those guys who are running ahead of you or stacking the queue. They may not be there anymore. And then that's the argument on the other side that's saying that, well, liquidity is going to disappear. And I would argue that's not real liquidity in the first place. That's fickle liquidity that can disappear at an instant. That's not natural liquidity. That's not real buyers and sellers. That's just, guys looking into clip a rebate here and there. So we'll see. We don't know. I don't know the answer to this, which is why I think a pilot is a great idea.
Yeah.
Let the data answer, the data will answer the question, and then we take it from there.
Question from the chat. Won't the reduced rebates discourage trading by institutions in those symbols and distort the testing?
Actually, just the opposite. What's interesting is that the institutions don't get rebates. So in other words, if I have an institutional client, they send me an order, we charge a per share commission just like every other broker. The broker collects the rebate. The institution pays a flat fee. It's not a pass-through situation here. So they don't even know. And this is why this is so distorted. They may send the broker an order and say, okay, here's a penny a share for this. The broker says, I think I want to make 30% more. So I'll post it on the bid side, try to get hit. And meanwhile, the stock starts to move away. And he's like, oh, geez, what do I do now? You cost your client, 2-3 cents because you were trying to collect a rebate, as opposed to saying, hey, I'm going to go, cross the spread and collect, I'm going to rip the stock. I want to own some here, and I'll pay the 20 mils or 30 mil fee. But that's the distorted process. The institution doesn't see that part. They just pay the commission. So that, along with some other things, if you want to talk about these new order routing rules, are really going to expose what's going on the institutional side. And I think there's a lot of institutional brokers that are going to have to change the methods that they've been doing.
Let's go into that, Joe. Talk about some of the new order routing disclosure rules that our brokers are going to need to comply with.
Yeah, so this is a big one. And just on the retail side, there's something called 606, right? And the 606 report will show a retail broker where they routed the flow. It'll just tell you, okay, they did 20% of the market orders on this broker and 50% on that exchange and so on. The 606, what they're calling them 606B3, the technical SEC rule filing, this is for institutional level, not held particular orders. The orders that we're talking about when it comes to, when I get orders from institutions, it's going to now have to expose, and this is actually set to start by mid-May, which is an aggressive time frame because there's actually still a bunch of questions on this, but it's now going to say, okay, Mr. Broker, not only do I want to know where you traded it, where did you post it bid side? Did you go in the middle? Did you collect a rebate? How much rebate did you collect? Lots of information on the order execution that never was out there before. And then it's going to be a bear, by the way, just to compile this information, but there are vendors out there that are helping. And then obviously a lot of brokers have set up their own things. They're going to get all this information. Now it's a data dump, right? And the institution, this is a voluntary thing by the institution. It's not going to be a public filing. This is not something that a retail investor could pull up and say, hey, I see Joe's routing for rebates. No, it's going to go directly to that client. And it's only with that client's flow. But the client can then say, hey, wait a second. I've got 12 brokers. Look at this guy. This one's popping out. He always sits looking for a rebate, and he's been collecting an extra 30 mils on my flow. And by the way, that's why his execution seems to stink all the time. This extra information will give the institution a lot more ammunition to say, okay, this broker, why am I trading with him? And it will really, what we think is going to happen, even before the information is given, the broker is going to clean up their act because they're going to be afraid that the institution is going to call on them and say, give me the information. So it could have a self-policing style event even before it happens. We think it's great. We think, the more transparency, the better it is. The less conflicts of interest or the exposed conflicts of interest are really going to start to clean up what we consider one of the biggest problems when it comes to, order routing in the institutional side.
Okay. All right, Joe. And you had one more topic that you wanted to touch on here and before we let you go. And that topic here, let me get to my list here. New amendments to Reg ATS, which will promote. Yeah, go ahead. Talk about that.
This is the third leg, right? This is the trifecta, I call them. The three things that are coming down this year that really, you talk about, the old saying, sunlight is the best disinfectant, right? There's so much sunlight that's coming on the institutional routing. This is it. This is the year. This is the year that will change everything, I think, on a lot of brokers. From the ATS perspective, so these are those dark pools, right? Or broker-owned facilities, alternative trading facilities. And they've had what they do nowadays, right before this rule started, was they file something called a Form ATS, which basically gives, it's a voluntary thing too. It's not public. You can get it if you look for it, but it will tell you certain information about how the ATS trades. Do they send IOIs? Is there indications of interest? Do they route to certain brokers? All the stuff that goes on inside of a dark pool that nobody knows. Under the new rule, well, now they have to be disclosed. And the new rule's already it's already started about a month ago. So the SEC has collected what they call these Form ATSs from all the 34 ATSs that are out there. And in that form, it's going to disclose arrangements with affiliates of other trading centers. Does the ATS have a co-location facility? What are the safeguards? But all sorts of information. Is there price sliding, post-onlys, conditionals, all the stuff that people never knew if it went on in an ATS? You're now going to know. However, you have to look, right? And here's where the onus will be back on the client. If you want to know what's going on in an ATS, they're not public yet. They're going to be put up by the end of the year. I believe the SEC will be putting them out. You can now look and put all these ATSs up against each other and see what's going on. And if you see something that you don't like, you don't trade there. Okay, so more disclosure, more transparency. This is what you need. Okay, you're not changing any rules. We're not changing any major rules in Reg NMS, but we're giving more disclosure. And again, these are tough things for the SEC. You know, this has been going on for years. They've been trying to get this one done. So
I mean, you
3
think
things
about
this year.
almost 40% of our trades are off exchange, you know, and that encompasses obviously off exchange market makers, but encompasses all the dark pools too. And we just don't know. Like I look at the consolidated tape and you see FINRA TRF. Okay, well, what the hell, you know, we don't know anything about those trades. I mean, here you've got all the public exchanges. At least we know where those trades are executing. And I don't know, obviously, the major brokers are probably going to have a problem if you start saying, you know, which brokers are executing these off-exchange trades. But more transparency is always a good thing. And we just don't know enough about what's going on in the dark.
Yep. And it'll be out there now. And again, it's just a matter of, you know, knowing where to look for it and then holding the brokers to account. Like if you're trading through a dark pool and you don't like something going there, don't trade there. That's where your order flow matters. And you have to kind of pull it and say, I'm not going to reward somebody that I think is doing something that is hurting my order flow. You just can't do it. And then once institutions and once traders start to do that, you're going to see the market change. The market will decide where the best place to be. And those are always the best solutions, right? You don't want excess regulation. I'm not for excess regulation, right? I'm for smart regulation. I'm for market-based approaches to solving problems that have been around for years. The market will decide who the best ATS is once the client understands where the information is, what information is there, and then they can direct their flow to the place they want to go. Makes sense to me.
All right, we've been on the line with Joe Saluzzi, partner and co-founder of Themis Trading. Joe, as always, thanks for your insights on the market structure. We'll keep in touch later in the year. Have a good one.
Hey, Joe, we're getting some kudos in the chat here. People really enjoy that discussion. We like to bring different people on and talk about different aspects of the market. And you're the best in the business on market structure. Oh, second best in the business for market structure. Triple D's number one.
No, Joe's the best.
Absolutely.
I learned everything I know from Joe.
We get it from both angles, right, Dennis? You take it from your side, and we'll get it right. But I appreciate that. I mean, this is really deep dive stuff too. This is, you know, in the weeds, and I'm glad people appreciate it because this is really the stuff that matters.
Thanks, Joe.
All right, guys. Have a good day. All right.
Thank you. 852. Spoos plowing higher. Little dip down to 82 and change. Trading near the highs of the session, 86 and a quarter. Nothing on the dailies. Then we get to 2,900. I want to cover tandem diabetes here for someone in the chat. And interesting chart here. You had the gap and go off earnings, and someone is really trying to keep this from a gap fill. So looking at the two lows, 59 a quarter, 59.41, there's your double bottom. So you're safely away from that. So that's what I'd be using to protect some profits here. Yeah. Now what I would be looking at to see if this is the rally for real, I would look at that high, let's just call it 75, low 59. So that's what, 15, 16 point move. Let's see if we can get back to 67, 68 and hold. So that's what I'd be looking here on the bump. But really that double bottom ahead of the gap. And that was also on close to the low on earnings day. So there's your major level. Better for tandem diabetes to get back over 67, 68.
Stock in a clear uptrend. It's a pullback to a major support level where you put in a double bottom. I mean, this is textbook. That's your out. So, I mean, if you're playing it here at $63 this morning, you got to find out at 59 a quarter. So I like the risk return here because it's a stock that's in a clear uptrend and these things come back. I mean, Roku had a similar setup a few weeks ago there, and Roku obviously had that downgrade with the stock lost 10 points in one day. But you know what? It challenged that level a couple times, drifted up, then came back and challenged it, and now it's past the test. Now Roku looks like it's ready to go there too. So completely different company, but similar setup where stock had a little bit of a rough ride for a little bit, but pulling back to a major support level, held, passed the test, and now it's actually challenging new highs. So I don't see why TNDM might not do the same thing. Again, if I was long this thing, I would not want to own it below 59 a quarter though.
All right. Also, Jar Jar wants us to take a look at DocuSign, DOCU. And the stock is having a nice move. Little bit of a pullback here. It looks like you found some pretty good support here. A bunch of lows in the 51 handles. So I think I'd use that for protection on the long side. And then kind of a similar setup. You came down from, let's call it an 8-point drop. Let's get back over 55 here and challenge the high of the move. Dennis, any comments on DocuSign?
Same thing. Stock in a clear uptrend gets a nice little pullback for you last week, and now you start to find buyers. Now you have a nice candle. Now you get some follow through for the 2-day move, which we're seeing here this morning. So now you're off the highs, so it's not as easy of a trade there. But I mean, buying stocks on pullbacks that are in uptrends continues to work. Spinner preaches it in the chat. I try to preach it on the show. It's all about where the overall trend is. DOCU trend is higher. I like buying those stocks on pullbacks.
All right. Another similar chart here for BEAT biotelemetry. Had an extended run, kind of in a little bit of a pullback from the all-time high. Once again, pair of lows to lean on here in the lower 57 handle. So if you're looking at a swing trade, you want to risk 2-3 points from this level. Yeah, it's been an
not as nice of a trend though. So that's one thing moving against you. You are significantly off the high. So you have an overhead supply issue because it's been a couple of months or two. It's the length of the pullback too, right? Like we often talk about buying stocks and that are in uptrends and pullbacks, but when the pullback's 2 or 3 days, there's not a lot of people, there's not a lot of memory there at that price. But when you're down for 2 months from the highs, it starts to weigh on it. Then you have an overhead supply issue. So the length of the pullback matters too. And this has been a pullback for almost 2 months here now. So you do have an overhead supply issue here. So it's not as easy of it as a TNDM or a Roku to come back because you have a lot of people who bought over the last couple months that are all down in the stock. So that being said, though, stock does have a level there, a double bottom for you to lean on. So if you're playing from the long side, I would not want to be long this stock. We took out yesterday's low, which is 57.13.
All right, boy, we got a lot of stocks here coming out of the chat.
Let's talk left. We haven't talked left for a while.
Oh yeah, you know what? I want to
for a while. It's been 1 day.
Yeah, well, no, not on the show. Well, you got to talk only the 3 days. Lift is on the show every day. When a big IPO, he's got to talk it every day, at least for 5 days. Give it some love. But anyways, I'm just looking here, and we called this yesterday when I had the ridiculous $42 price target come out from Seaport, and I predicted that would close green. That was when the stock was $66. I missed that prediction by 4 cents because I think it ended up closing. How much did I miss it by? 4 cents? Close previous day 69.01, close 68.90. So I missed by 4 cents on the prediction, but it is green here today. So 3-day rule worked. It turned around. Everybody was capitulating on the pre-market there when they saw the crazy price target. Oh, $42. I better sell now. And that might have marked a short-term bottom in the thing. But now, so if you're playing it, 66.10 is the level you're going to lean on there. Could it come back up and challenge the 75 high there? Just going back to 2 days ago.
Yeah,
I think it could totally challenge that. So, but you're kind of in the middle now. It was a little bit better setup yesterday when I was in the 66 handle, obviously pre-market, when I was looking for the turn, and we got the turn early, just like we said. So now it becomes a little bit trickier because now you're buying it almost 4 points off the low, and you're only looking at maybe 5 points upside. The risk return is more balanced here. So if I'm looking at, I think, yes, you take out yesterday's high, you could start to move up through the 70s, but hard to really get that excited about it. The risk reward just isn't as nice as it was yesterday morning when Seaport put that ridiculous $42 price target on it.
Jar Jar got a 1.5 trade-off lift yesterday. He said, "Thank you, Dennis."
Nice job, Jar Jar. I wish I would have been playing it with you. I did not.
And the other thing I noticed about that is it didn't get to the pre-market low. So if you were using like the pre-market low as a stop out point, I think that was like around 65.5. For me, the big test here, if this 66.10 low is valid at 75 high, I see that's your 2-day high, your only high. But once again, if this gets up, a lot of people underwater in this one. Let's see if this low holds here, gets back up to 77, and that would be your 50% retracement from 88.60 down to 66.10. And I think this stock's going to trade some around 72. That's also an area of interest because that's where it was priced. So let's.
Yeah, you're right. That's a great point too. As the 72 becomes a major issue there. So before we even get to 75, we have to contend with 72, and the reason that is there's probably a lot of people who bought this. Maybe they didn't sell on day one. They were hoping for a lift, and then, no pun intended, and then it takes out the 72 IPO price. So now they're looking to get their money back. So great point, Joel. 72 might be the first level to challenge here if they challenge it today. So before I even think about 75, let's think about that 72.
And real quick before we wrap up, I'll just cover two real quickly. New in the chat is asking about Microsoft. Not much to say about it, but two real sleepy days here. All-time high 120.82, all-time closing high 120.22. Tight range yesterday, but those what I would use for targets. And Twitter, someone's asking about Twitter. That's just been sneaking its way back up. Yeah, I do have a couple. Dennis, you still got that swing trade?
Yeah, I'm still on the swing trade.
Nice.
So I'm in for $30.90. I actually was in originally just trying to fill the gap, which it did.
Yep.
So I probably should lighten it up here. But this market is so strong here. I feel like there's more gusto in this one yet. So that's why I'm trying to hold on. I'd love to get up in the 36 handle there, but this was not a long-term investment. This was a swing trade, and I'm still holding it. It's been a long hold. I've been in this one, I feel like forever. Like this is like a long trade for me. You know, they get the guy who's in trade sometimes for seconds. I've been in this one for, it's got to be going over 2 weeks now, maybe 3 weeks. So I don't know. I kind of like it here still, so I'm sticking with it, but shorter leash. I don't want to let the swing trade profits go away, and I am up, almost 10% now, so it's a pretty good trade already.
All right. On that note, let's wrap it up for today. Thank you to our guest, Joe Saluzzi. Thanks to all of you in our chats on YouTube and premarket.benzinga.com. If you missed any part of our show, you can catch our podcast, iTunes, SoundCloud, Stitcher, TuneIn, and Google Podcasts, or just rewatch our show on YouTube. Please remember, all of the information from our show is for informational purposes only and not meant to be investment advice. On tomorrow's show, we'll be joined by Mark Chaikin, who's the founder of Chaikin Analytics. In the meantime, everyone have a good rest of your day. Good luck out there, and we will see you on Thursday.